We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Modrovic. Joining me today is Matt Geiger, managing partner of MJG Capital. Thanks for joining me today, Matt.
Great to be back on the program here, Tom. Thanks for having me.
It's excellent to speak to you as always. So going through your end of quarter investment letter, what do you attribute your strongest 6-month performance since the fund's inception in the second half of 2022?
Yeah, so that is the case. In second half 2020, we were up 102% over that 6-month period, which was by far our strongest 6-month performance since inception. It's interesting that actually coincided with this ongoing correction that we've seen in precious metal prices, really from last August. So we're going on close to 12 months. It's not a particularly painful correction, I should add. There's a lot of doom and gloom out there amongst gold and silver bugs. But we have to remember that we were just at all-time highs less than a year ago, and we're still only 10-12% off of the all-time high level, just below $2,100 an ounce. So I think we're in a good place. In terms of our performance, though, it had primarily to do with our energy metal names within the portfolio, and we made the strategic decision in early August, late July of last year, to stop initiating any new precious metal positions. This wasn't a broad market call on timing. It ended up being fortunate from a timing perspective. It had more to do with allocation within the MJG portfolio. And we were at the point where at one point, 75% of our weighted portfolio was exposed to gold or silver equities, which was far higher than we'd seen before. And so, yes, energy metals really took off from that late August through February, March time period. We had one holding in particular, Nova Royalty, who went public over that period and proceeded to absolutely tear into all-time highs above $6 in early February of this year. We have had a bit of a consolidation period so far in 2021. In the investor letter that I just sent out a couple weeks ago, we were up moderately for the first half of the year, which a little bit disappointing, especially in light of the performance we saw last year. But I'm actually okay with that. After a strong, anomalous gain, a consolidation period can often be healthy. So that's where I feel we're at the moment.
So Matt, after we've seen those excellent gains, let's say in 2020. What has contributed to make a softer market so far in the first half of 2021 as we look back here? Your portfolio is exposed to a lot of different metals and commodities. So how do you see let's say the commodity market as a whole over the past 6 months?
Sure. Well, as mentioned, we have been in this pullback for gold and silver here since August of last year. So we'll put those metals aside. In terms of the rest of the commodity complex, we had that stunning run from Q3 of last year, right when the precious metals started to pull back, really through mid to late February of this year. I think the juniors, really of all stripes, got quite ahead of themselves, especially if you're looking at the energy metals. So even though commodity prices generally have continued to march higher, at least by judging from the Bloomberg Commodity Index, which is close to yearly highs still at the moment, we have had this pullback period amongst the junior space generally, which I think is healthy. In all honesty, over the past 3 or 4 months. So, ultimately, the market's going to go one of two directions here. I think if the general market hangs in there and continues to march to all-time highs, we're going to see commodity prices continue to rise along with it. And then at some point, the juniors are going to have to play catch up. And they could do so in a dramatic manner like we saw in the second half of last year. Conversely, even though the industry or the mining industry as a whole, I'd say, has been relatively well behaved in recent years in terms of minimizing G&A, making astute acquisitions, focusing more on minimizing costs and distributing cash to shareholders via dividends and buybacks. That said, if there is a broader risk-off event, we're going to get a hit straight in the lips, as I like to say. When there's a broader risk-off event, that's just the way it works ultimately. And even the strongest multi-year commodity bull markets are often punctuated by 1, 2, or even 3 of these really stomach-turning pullbacks along the way. So I'm not expecting it to be a smooth ride by any respect. And when the broader market next goes sour, I've psychologically prepared myself and the fund's partners, for there to be some short-term pain, as there always is. That said, from a medium to long-term perspective, whether you're looking 3 years out, 5 years out, 10 years out, I think we're at a very, very good place here as natural resource investors. There are multiple metrics you can look at, but whether you're comparing commodity futures as a basket relative to the S&P 500, looking at the GSCI or the Bloomberg Commodity Index, going back 100 years, we have not seen commodity prices this cheap relative to the broader stock market. And that's even after the run we've seen over the past, year plus from the coronavirus drawdown in Q1 of 2020. GMO, and I included this chart in the fund's most recent investor letter, put out data in early June showing that natural resource equities as a whole, and this includes energy names as it does mining names, as it does agriculture. Also, when compared to the S&P 500, we're looking at 100-year lows. And then Bernstein earlier this year did a good study where they looked specifically at mining companies, and these are the producing mining companies. And these guys, compared to the S&P, haven't been this cheap going back nearly a decade. So on a whole host of metrics, even after the performance that we have seen, we're still very cheap relative to the broader market. And so I'm a big reversion to the mean guy. I think something has to give here, but it's not going to happen overnight. It's going to take time. But I think that's likely what we'll see over the course of this coming decade. These disparities to reconcile to some degree. And if it overshoots towards in the hard assets favor, then great. If not, and we just see reversion to the 30 or 50-year mean, there's still a lot of room to go here.
And of course, we'll include that chart in the video here, but it's a very stunning, very dramatic chart to really show how undervalued these energy and metals companies are, right?
That's right. But I think it's important to note, some folks would say, oh, well, GMO's data included oil, natural gas, coal names, maybe energy's out of favor, hydrocarbon pushback against CO2 emissions, that's probably skewing the data, and maybe it's not as ugly as it seems. But again, just earlier this year, Bernstein did an analysis specifically to the metals and mining company. So taking oil, gas, and coal out of the equation, and we're seeing the same thing. So that gives me confidence. But as we all know, markets can stay irrational far longer than folks can remain solvent, and so it's foolish to think that this is going to correct in a quick and in easy manner from our perspective. I think investors in the space need to be willing to hunker down and withstand some extreme volatility. But with patience, I do think we see these disparities reconcile, and in the process, there's a lot of money to be made.
Yeah, it seems just to be able to have patience and see these, let's say these short-term news and short-term issues affect the market negatively for us as investors. That doesn't necessarily change our long-term outlook on the let's say the precious metals thesis, for example.
That's right. Well, it's easy to say. It's harder to do that in practice. Mm-hmm. And I mentioned earlier there has been a lot of doom and gloom out there amongst the precious metal investors. Based off of this period of weakness we've seen since last August. And I just want to remind folks, this is not a terrible place to be. Just 10% off of the all-time highs, just at less than a year ago. Nice consolidation period. We're starting to see M&A pick up, both amongst the royalty players and then the miners generally, which makes sense. When prices are moving straight up, the sellers don't want to sell because they think they're going to be missing out on greater gains. Buyers don't want to buy because they feel like they're buying in an inopportune time. And when you have these consolidation periods, it can be healthy for the market. It brings parties to the table, and that's what we're seeing. So I would urge folks listening to this to take the longer term view, not get too caught up on the weekly, monthly, even quarterly fluctuations with their portfolio. Keep in mind why they're in this space, and also think when they would potentially exit the space. And I know we're talking way out in the future here, but if you're looking at these same charts, say 5 years from now, 7 years from now, 10 years from now, and suddenly you're seeing that commodity prices generally or mining equities as a whole are more expensive to the S&P 500 than they've been in the past 50 or 100 years, then maybe it's time to tap the brakes and take some or all the capital off the table. But until I see that as an investor, and we're nowhere close to that, we're going full speed ahead from an MJG perspective.
Mm-hmm. So, Matt, what was the gold to copper ratio telling us last summer that you picked up on? This is a relationship that, or a ratio that I haven't seen anybody else really highlight or look at, and I thought that was really interesting that you showed it in your letter. So, what was it telling you?
Yeah, so I try not to do all too much macroeconomic forecasting as much as I can. Obviously, we all need to have views in terms of where the market is generally. But from my perspective, when we're choosing investments, it's very much on a bottom-up basis. When we're looking at companies, we're looking at the people, the quality of that company's given asset, the company's financial structure, upcoming catalysts, price to value, all of that good stuff. I try not to make calls on which metal is going to be the flavor of the month and which is not. All that said, when you're looking at certain data points, if you see extremes, sometimes something jumps out to you. And so, last summer, and we'll take the audience back to July, which is when I wrote the second to last July 2020 MJG letter, which included a piece called Copper, Gold, and a False Choice. And in that piece, I made a pretty simple point, and that was looking over the past 40 years, copper had never been cheaper relative to gold in that 40-year period. And this goes right back to the end of the 1970s, right before Volcker flicked the switch on increasing interest rates to drown out inflation. And to me, that didn't make a lot of sense, especially given copper's very important role and ongoing role here in the decarbonization of the global economy. And I also knew that those metals, while they don't have to move in tandem, often do, at least over the medium and long term. And so, at that time, copper was trading at around $2.70 a pound, while gold was just a few weeks away from hitting its all-time high, just below $2,100 an ounce. And the point I made was pretty simple. Copper is very cheap relative to gold. From a macro perspective, from a narrative perspective, that seems a little bit strange to me. And that if you're bullish on gold, great, I am too. I think you should also be bullish on copper. That said, I also made the point that I think the ratio will normalize, but I didn't expect it to happen overnight. So that was the one part I was wrong about. We proceeded to see copper in the next 12 months shoot up to an all-time high of right below $4.80 per pound. It's consolidated a little bit from that point. Whereas gold, as mentioned, has had that 10% pullback or so from all-time highs, and there's no longer as much buzz around the metal. And so in the most recent investor letter from just a couple weeks ago, that's available on the MJG website, I noted that because of this dramatic reversal in fortunes for the two metals, we now sit at roughly the 40-year mean, maybe a little bit below that. And so at this point, I think it's the ratio is something that's interesting to watch, but we're at the rough average, so it's hard to make any dramatic calls about what's going to happen. I did point out, however, in the most recent piece, just for illustration's sake, that if we were to see the copper gold ratio at levels back in 2007, which was right at the end of the 2002 to 2007 China-driven commodity super cycle there. We in theory, and at that point, copper was more expensive relative to gold, so it was totally flipped on its head. than it had been since the early 80s. If we saw that ratio again, we could in theory see gold not move budge at all from, its 1800 or so level currently. And copper could, in theory, if that ratio were to return, move as high as $10 per pound. That said, that's not a projection. I actually do feel pretty strongly that we will see $10 per pound copper sometime in this next decade. But I think it's likely that gold will also be dramatically or significantly higher as well over that period. I don't expect gold to hang out at its current levels at all. But yeah, I'm trying not to draw any too strong of conclusions now, because the disparity between the two metals is not nearly as extreme as it was just 12 months ago.
Well, like you say, when that ratio is at an extreme, that seems to be more instructive, right? And it did revert to the mean, as you like to point out. That's right, Tom. So Matt, your portfolio is comprised of 5% nickel exposure. Given the supply shortfalls, are you looking to increase that exposure by chance? And what are your thoughts about the whole nickel supply shortfall equation here? Right.
Well, I do think nickel's a great place to be. Again, with the caveat that I try not to chase flavors of the month in terms of particular metals. And we are seeing the narrative return to nickel, even in just recent weeks. There's been a market uptick in the prices of some of the higher quality nickel sulfide players. That could be Western areas, which is a producer. It could be some of the high quality developers out there like Centaurus down in Brazil, or some of the Aussie names, Legend, Minco, Poseidon, some of these guys. So look, nickel's a metal that's also going to benefit from this continued decarbonization trend. Elon Musk, and many of your listeners may be aware of this, is on the record calling lithium-ion batteries nickel-ion batteries in order to emphasize the importance of the material to the battery chemistry. Taking a step back, if we went 15 years in the past and looked at the chemistries of these lithium-ion batteries and focused on the cathodes, you would be looking at roughly 1/3 nickel, 1/3 cobalt, 1/3 manganese. It's very well understood now that the chemistries are shifting dramatically in nickel's favor. So much more heavily nickel-rich chemistries to the point where the status quo, at least in the coming years here, is going to be 8 parts nickel, 1 part manganese, 1 part cobalt. And then there's also battery makers out there currently that are trying to eliminate cobalt entirely from the battery, which would be to nickel's benefit. And so, yes, nickel does benefit from some of these macro trends that we're seeing. But again, I would urge investors to not go buy something just because it has nickel in the name or they're focused on a specific nickel project. It's going to be a stock picker's market here. Sulfides are probably the lowest hanging fruit at the moment. That's largely the preferable form of nickel production. The issue is there's just not enough nickel sulfide development projects out there, and very unlikely to be sufficient nickel sulfide discoveries in the future in order to cover projected nickel demand from batteries. And so at some point here, I think at least a few of the laterite projects are going to have to come online. This is something I touched on in the January 2021 MJG letter. The fact that the battery industry is going to have to rely on laterite projects to some degree in order to meet future nickel demand. And laterites are difficult in a lot of cases. Each project needs to be evaluated in its own right, but they're generally much higher capex. Very difficult to actually operate. It's well known in the industry that these are often chemistry experiments. And even if you get a laterite operation up and running, oftentimes you'll see it never reach expected nameplate capacity, just because the difficulties in processing. So look, there's a lot of work ahead in the nickel industry. It's going to be an interesting balance. Obviously, as investors, we want the price to rise as high as possible. That will be good in the short term. By the same token, there is substitutability or substitution risk here if nickel producers don't get their act in order in relatively short order. So to get back to your question, look, I mean, we're at 5 or 6% nickel exposure. I'm not going to go out of my way to add a couple names to the portfolio just to boost that for the sake of boosting it. However, if I come across a new nickel opportunity that looks attractive, I certainly won't hesitate. And then additionally, there's always the possibility to add existing exposure to positions that we already hold. We have a couple nickel focused positions at the moment. So that's another way we could get that percentage probably up closer to 10%.
So Matt, as I go through the spreadsheet to see how your portfolio is weighted, I noticed that you're 14% weighted to phosphate. So for those in our audience that don't know what phosphate is, can you explain the case for us here as well, please?
Sure. So phosphate is one of 3 essential ingredients into inorganic fertilizer. The other 2 being potash and then nitrogen. And look, the world needs to eat, and we are, for better or for worse, reliant on inorganic fertilizer for the foreseeable future. On a per acre basis, we continue to pour more and more fertilizer across the world in order to increase yields. And while there are diminishing marginal returns, and maybe this isn't the best long-term strategy for society, it's what we continue to do. It's worth noting, just out of interest, that phosphate is 1/10 as common as potash in terms of its appearance in the Earth's surface. And so it's quite a unique material in that regard. Also, the vast majority of phosphate production comes from Morocco and the Western Sahara. And so if you look at a concentration of where it's coming from as a percentage of total global supply, we're far more dependent on Morocco than we are, say, Saudi Arabia or even OPEC from an oil perspective. So I found this pretty fascinating. In terms of the specific investment we made, it was more of a bet on a certain management team, a certain project at what I felt was a very attractive valuation. That said, I am attracted generally to the fact that there are only 3, maybe 4 listed phosphate-focused juniors in North America at the moment. And from my perspective, it's been 15 years or so since we had the last ag mineral boom. Usually once every commodity cycle, there is a year or 2 period where you see a lot of speculative excitement come into this space. And so the lack of investable vehicles currently in North America, I think bodes well for the management teams that are actually pushing ahead with these development stage assets. So look, I'm excited about the future for these ag minerals. I think if you add potash, we're looking closer to somewhere between 15 to 20% of the weighted portfolio. That said, to be clear, we only have one phosphate focused position, and we initiated it at roughly a 5 or 6% weighting. And so that higher percentage you're seeing is due to a run in the share price, because a lot of these names have gotten attention over the past six months, as we saw phosphate and potash prices have moved markedly since the coronavirus sell-off of early last year, and they're currently at close to 52-week highs. So I'm unlikely to initiate any further positions, just given the weighting that we're at. But it's definitely an investment in a space that I'm excited about for these coming years.
One of the last, let's say, alternative metals, maybe that doesn't get as much coverage here, that I'd like to touch on with you is vanadium. So why does the demand picture for vanadium, why is it primed for significant growth in the years ahead?
Sure. So vanadium is an interesting one. Some of your listeners that have been in the mining space for a few years now may remember the speculative rush back in 2017 and 2018, when we saw prices of the 2 main vanadium products ferrovanadium being one, vanadium pentoxide being the other, rise close to sixfold in a 24-month period. As the market anticipated more stringent rebar standards in China, and the Chinese government did eventually increase the steel standards, which basically means that more vanadium needs to be added per unit of steel in order to strengthen the material and increase durability. Clearly the price got well ahead of itself. Vanadium is also a common metal that sees these boom and bust periods, once or twice every decade. And so, speculative attention has absolutely gone elsewhere. It's not a metal that anybody's talking about at the moment. A lot of investors, generalists and ESG focused investors that might have come into the mining space over the past 18 months have probably never even heard of vanadium to begin with. In terms of demand for vanadium, the key point here is that 90% of it is coming from steel. So from that perspective, it's not all too sexy. Vanadium is used to strengthen steel and strengthen the rebar that is used in, say, bridges or apartments or skyscrapers, what have you. It's also used to strengthen steel used in the chassis of automobiles. And so it's a bit of an unglamorous application, probably growing at about a 2% compound annual growth rate per year. However, there are a couple interesting other niches where we're going to see increased vanadium demand. The first is in alloying, in terms of high performance materials, beyond steel. And so, the example here would be the vanadium, titanium alloys that are used in aerospace industry, or vanadium used as a chemical reagent for different chemical processes, and environmental cleanup as well. So that's about 6% roughly of vanadium demand currently. And then 1 or 2% is coming from vanadium redox batteries, which is probably where the greatest blue sky is for additional vanadium demand in the future here. That part of the market has a chance to grow at a 15% compound annual growth rate here, say over the coming 5 or 6 years. And the World Bank estimates that if things go to plan, by 2050, more than twice of current annual vanadium demand will be used for batteries alone. So again, that's looking far out in the future. It's entirely impossible to know at this point whether that World Bank projection will prove to be accurate, whether it will prove to be grossly conservative, whether it will prove to be grossly aggressive. But I think the point and the two key variables will come down to how much does the energy storage market, especially for grid scale battery storage, grow over the coming decades, and B, of that market, how much of it is captured by vanadium. So those are the two variables that you're going to be looking at. But look, vanadium redox flow battery technology, it's pretty fascinating. There are quite a few advantages of this battery technology, relative to the competition out there. The first is that you can have these batteries run for 20 to 30 years with very, very little degradation. So for thousands of cycles, very little degradation. That sharply contrasts with lithium-ion batteries, who wear down pretty quickly. Once you get up to 1,000 charges and beyond that. Second advantage is that they're not flammable. So it's the safety aspect. And, we've seen pictures in the news just recently of Tesla batteries on fire. We've heard about, Panasonic phones, bursting into flames on flights. These are real issues, especially as batteries become more and more prolific. So you don't have any of those concerns with vanadium. It's also helpful that they're entirely recyclable, after use and can be repurposed. And that's not the case if you're looking at lithium-ion batteries either. And then in terms of discharge timing, which is important for these grid scale applications, vanadium's pretty good between the 6 to 12 hour sweet spot. And so the idea there is that maybe you would accumulate, energy in the batteries through, wind or solar power generation during the day, when the wind is blowing and the sun is shining, and then you can then discharge that to the community in the evening when electricity use is highest. And lithium-ion batteries are useful, but they really excel in that 2 to 4 hour discharge range, where vanadium redox is, you take a step higher than that. But look, there's a lot of competition out there. Lithium-ion is the most established battery technology. Even though from my perspective, it's not ideal for grid scale storage, that's going to be, a clear competitor. There are some interesting zinc battery technologies out there, zinc hybrid or zinc solid state batteries. So very smart people working on that technology. Zinc obviously is a much more prevalent material than vanadium. So there is some appeal to technologies that employ zinc as the primary material. Hydrogen batteries are a potential source of competition. Molten salt batteries are a potential source of competition. And then it's also important to note that currently, if you're looking at grid scale battery storage, 90% of it comes from hydro batteries at the moment. And so using water to store power and then release that energy when the time comes. And so look, it's going to be an all-out brawl. The technology is going to be continually advancing over these coming years. It's going to be fascinating to watch. But I think there is a niche in there that will be carved out for vanadium redox batteries. And there's some really smart people, working on this technology, including Robert Friedland and his VRB Energy company based out of China. So listeners who are interested in that can do a little bit of research and learn about what they're up to.
Excellent, Matt. I'd like to turn away from specific minerals and metals here and ask you about how you look for optionality plays and what optionality means to you. Maybe we could take that from two different perspectives. I know that you've been participating in more private placements, so maybe you can look at it from, let's say, an investment standpoint, and also optionality when it comes to investing in particular types of projects with a resource that they might have sitting there that isn't economic at current levels, but once this super cycle really takes off, could provide a lot of extra alpha on the way up. That's right. So it's a relevant question, considering that in the most recent investor letter, our featured investment was a company called Strategic Resources, which in essence, and from my perspective, is a vanadium-focused optionality play. Now, I should caveat that this is not our typical form of investing. So I describe an optionality play really as an out-of-the-money call option on a given metal price. And usually these types of projects are defined by having very large resources, generally being quite low grade, generally being quite high cost, both from an initial CapEx perspective and then also in terms of a cost of production perspective. And also generally has a lot of money already put into the ground. But if you look at these projects and ran the numbers at current metal prices, and whether it's a vanadium or whether it's a gold or whether it's a copper price, if you plug in the current metal prices and use reasonable assumptions, they don't make sense on paper, right? They won't be built. And so that generally is not our style of investing. In fact, it very much isn't. We only have two names within the portfolio that I would consider, quote unquote, optionality investments. And the reason we've made exceptions there is sometimes I'll look at all the other boxes that we like to check with investments in terms of the quality of people, the company's financial structure, strong upcoming catalysts, good price to value, good portfolio fit. All of that good stuff. And sometimes all of those boxes are checked. And if I have extreme confidence in the management team, then there is the option to dabble a little bit with optionality investing. But again, generally not our style. There are investors out there, maybe Thomas Kaplan's Electrum Group or Sun Valley Gold that specialize in this type of investing, have actually done extremely well. That said, to deploy optionality investing successfully, you have to be very good at calling metal price directions and getting your timing right. And, from my perspective, just knowing my skills as an investor, that's extremely difficult.
So I'd rather look at these, generally look at these higher quality projects that make sense at current metal prices, or even at lower than current metal prices, and at least on paper still look worth building and could always be acquired by a bigger party. And so, that's kind of the split between what I consider high quality projects and then your quote unquote optionality plays. That said, if you invest in an optionality play and you get the metal direction right, you can go from scenarios where a given project is worth $0 from an NPV basis, let's say $2.70 copper, $3 copper. But should copper go up to $6 or $7.50, this very same project, at least on paper, can be worth billions of dollars, right? So the amount of leverage that you see with some of these optionality plays is pretty tremendous. The question though is, do you have the patience to wait to be right, and are you able to time your bets appropriately? Because obviously leverage does work in both ways, and and while you're waiting, there's very little chance that these projects will be bought out in a lot of cases by larger parties, because they're simply not attractive relative to the other development assets out there. So that's kind of the quick and dirty on optionality. Why we generally avoid it, but there are a couple exceptions in the portfolio where, due to my confidence in the people and other company specific fundamentals, we've been willing to make a bet, despite the projects not making sense at the current metal prices that the company are focused on.
So the other side of that, Matt, explain to us what are the different variables that you're considering when you're evaluating a private placement opportunity for investment here. We can in a way we can kind of look at warrants being attached to an investment as a possible optionality play as well. Is that right?
Yeah, you can. I mean, the word optionality is thrown around a lot in this industry. I guess when I'm talking about optionality, I really do try to keep it narrow and focus on the specific type of investment that I just described. Mm-hmm. That said, yeah, warrants do give you optionality or added upside, added leverage when you participate in private placements. And it is also a relevant question. Our past 5, even 6, I believe, newly initiated positions have been through private placements. The fund will, when we add a new position, it's usually half and half. Roughly half the time we'll buy on the open market through common share purchases, like a lot of your listeners will do. Generally the other half of the time we will participate directly in private placements, give money directly to the company, so that they can advance their operations further. But as I mentioned recently, we've been much more skewed on the private placement side. In terms of the different variables that I look at, I mean, the very first thing I do is try to put the deal to the side and just look at the company with clean eyes. And you can even assume or pretend that the company has enough cash to get through its next major milestone, or maybe its next major couple milestones. And you ask yourself, is this a company that I would invest in, placement aside? Are these good people? Are they working in an area of where they've been previously successful? Are they well incentivized? Are you getting in at a similar cost basis? Are there other smart investors that you respect that are in the deal as well? All that good stuff. Then you look at the asset quality. Does it make sense at current metal prices? Is there expansion potential beyond what you have? Are there any clear hurdles in terms of obtaining social license or permitting from an environmental perspective? All of that stuff. Then looking at the company structure. Then looking at their upcoming catalysts. Then looking at their price to value metrics. Then looking at the fit of the company within your portfolio, both jurisdictionally and commodity. So you wanted to look at all that stuff and really put the deal to the side. Assuming that all those boxes are checked, you're like, okay, this is a company I could see investing in, even if they weren't conducting a private placement. And you're like, okay, well, let's look at the actual deals here. So look at the actual deal here. And I wrote down a few key variables. This is not an exhaustive list by any means, but you want to look for a few things. First, is the company raising enough money where they can get through that next major catalyst, and even better, a couple major catalysts? If it's just to keep the lights on raised, then what's the point? So if you're going to be giving money to a company, you want them to be directly addressing an unanswered question. And maybe it'll be resolved in a positive way. Maybe it won't. But at least they'll have enough money to give you an answer. And that's very important as an investor. Secondly, look at who else is coming into the deal. How much of that deal is being taken by the current management team, right? Maybe the current management team has 20% insider ownership, but for whatever reason in this specific deal, none of the key players are taking anything. Maybe that means that the company is not nearly as attractively priced as it was in the recent past. Conversely, maybe there's a management team with 10% ownership of the company, but you ask them how much of the deal they're taking, and between board and management, they're taking 30 or 40% of the deal. That might tell you something about their view, at least, on the company's prospects. You also want to look at other investors in the name that aren't part of board and management, especially some of the earlier investors, and especially if you trust their judgment. And so investors will call this signaling. You're basically looking if some of the previous investors are following on, or maybe even doubling down with their previous investments, or conversely, maybe there's been a group that has participated in said companies, through past 3 placements, but in the current one you're evaluating, they're not touching it. And that's at least a yellow flag and a potential cause for concern. You also want to look at, of course, the actual terms, right? And oftentimes for these placements, you'll be able to get shares at a discount to the current market price. Obviously, a discount is much better than at market, and at market is much better than a premium. So you're going to want to evaluate that. Then you want to look at, well, is a warrant included? Sometimes a warrant's not included, and if it's a company that we're already invested in, or it's a company that checks the boxes and passes with flying colors, we will still consider a deal without there being a warrant. That said, a half warrant is infinitely better than no warrant, and a full warrant is twice as good as a half warrant. So you want to consider that. You also want to look at the warrant premium. So pretend the deal is taking place at $1. It's much better to have the warrant priced at $1.25% or a 25% premium than it is to have the deal priced at $1, but with a warrant at $2 or 100% premium. So again, from an investor perspective, the lower that premium, the better. Sorry to put you to sleep here, but I guess 2 more points of importance. This next one is very much from a U.S. investor perspective. You want to look at the actual language in the deal documentation and in the subscription agreement, and particularly the legend removal form. Depending on that language, at least from a U.S. investor perspective, it could be the difference between playing on the same playing field as your Canadian counterparts, or conversely having to wait an entire year before you can take any profits in the name. And so, again, when we invest in companies, our goal is to be holding them for a matter of years. The management delivers, there's a company gets lucky to some degree with what they're trying to prove. The share price doesn't get too far above fair value. We're there for the long run. That said, things do go wrong in this industry. You don't want to put yourself at a liquidity disadvantage to other investors. So depending on whether it's have sold or will sell language in the subscription documents is a key variable. And if anybody has questions about that, that's a whole nother rabbit hole we can save for another day. But I'd be happy to answer questions directly. And then the very final point is the timing of the placement. So it's a yellow, if not a red flag, if the company has already raised money or has raised money in the previous 4 months. As you know, this industry kind of works around the 4-month hold period. And so if you're participating in a placement and there's been another placement within the past 4 months, you can be sure that after you've set your money in and the deal is closed, very likely after the 4-month hold lifts for the previous placement, you're going to see the share price drop, probably the levels below where you put money in. So that's often a yellow or red flag. There are, of course, exceptional circumstances. So again, this isn't an exhaustive list, but these are a bunch of the different, specific variables that I'll look at when evaluating a private placement. But to repeat, that's after I've looked at the company through the lens of a standard investment.
Excellent, Matt. Well, I think we touched on a lot of different topics here today. Do you have anything that you'd like to add before we wrap up?
No, not so much. It's great joining you again here, Tom, and being able to connect with the Palisade audience. As always, all investor letters, all interviews, including this one, recent site visits. I was able to go out to Ridgeline Minerals property last month in Nevada, which felt great. First site visit since coronavirus reared its ugly head. So it's good to get back out in the field. And there's also a form there to contact me if you'd like to be added to our distribution list, or just chat about the fund generally or specific investments. I always like to interface with Palisade listeners. So thanks again for having me on. I look forward to doing this again soon.
Absolutely, Matt. It's always great to have you and to catch up. Of course, your website where all the letters are is mjgcapital.com, and also your Twitter handle is Geiger Accounting. Thanks for your time today, Matt.
That's right. All right. Thanks, Tom. Good chatting.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.